we're going to be discussing a recent article that highlights 4 companies in the financial sector that have a strong track record of paying dividends. These companies, Chubb, Aflac, Cincinnati Financial, and T Rowe Price, have been identified as having long dividend histories, well-covered payouts, and business models that generate cash through economic cycles. The article notes that Chubb and Cincinnati Financial are defensive players in the property and casualty underwriting space, with fortress balance sheets that can weather storms. Aflac, on the other hand, has a verified multi-decade streak of dividend raises, making it an attractive option for income investors. T Rowe Price, meanwhile, offers a high-yield option with a mid-single-digit yield, making it a compelling choice for those seeking current income. It's worth noting that each of these companies has its own unique strengths and weaknesses. For example, Chubb and Cincinnati Financial may be exposed to catastrophe risks, while Aflac faces pressure from variable investment income and currency fluctuations. T Rowe Price, meanwhile, is dealing with persistent net client outflows which could impact its revenue mix. As we always say on the Riskwiser Zone, it's essential to do your own research and consider multiple perspectives before making any investment decisions. While these companies may have attractive dividend yields, it's crucial to evaluate their underlying business models, financial health, and growth prospects before adding them to your portfolio. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and exploring the latest developments that could impact your investments. Let's start with Tanla Platforms, which has reported a significant increase in revenue and profitability. The company's CEO, Uday Reddy, attributed this growth to the rising demand for its cloud communication services. However, some analysts have raised concerns about the company's high valuation multiples and the potential risks associated with its business model. On the other hand, we have BlueStone Jewellery, which has seen a surge in its stock price after reporting strong Q1 results. The company's revenue rose by 48.8% year-on-year, driven by resilient consumer demand and the relevance of its portfolio across different price points. Systematics has maintained a buy rating on the stock with a target price of Rs 832, citing the company's expansion plans and improving store productivity. It's essential to approach these stories with a balanced perspective, considering both the opportunities and risks associated with each company. While Tanla Platforms' growth is impressive, investors should be cautious about its valuation, multiples, and potential risks. Similarly, BlueStone Jewellery's strong Q1 results are promising, but the company's performance will depend on various factors, including gold price movements and consumer sentiment. As we navigate these complex financial stories, it's crucial to stay informed and adapt to changing market conditions. By doing so, you can make more informed investment decisions and mitigate potential risks. Welcome back to the Riskwiser Zone. Today, we've been exploring various aspects of risk management and investment strategies. As we wrap up this episode, I'd like to share an insightful article from the Financial Post that caught my attention. The piece discusses key considerations for investors when buying stocks, particularly those with high growth potential. According to Peter Hodson, founder of 5i Research Inc., traditional valuation metrics such as price-to-earnings or price-to-sales ratios may not be helpful when evaluating high-growth stocks. Instead, investors need to gain a deeper understanding of the company's future opportunities and how likely they are to capture them. This requires a more nuanced approach, looking beyond simple ratios and focusing on the company's potential for long-term growth. Another important point Hodson makes is that momentum should not scare investors away from buying a stock. In fact, a rising stock can be a good indicator of a company's potential, as it often feeds upon itself, driven by factors such as fear of missing out or multiple expansion. Rather than being deterred by a stock's recent gains, investors should try to understand why it has risen and assess whether the growth story is still intact. It's also worth noting that investors don't need to go all in on a stock right away. Buying a partial position can be a great way to test the waters, commit to further research, and track a company's performance before deciding whether to increase their investment. This approach can help mitigate risks and provide a better purchase price if the market or company experiences any setbacks. As we conclude today's episode of the Riskwiser Zone, remember that investing always involves some level of risk. It's essential to be informed, disciplined, and patient in your investment decisions. By taking a thoughtful and nuanced approach, you can make more informed choices and navigate the complexities of the market with confidence. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.